Hey everyone, welcome back to Corporate Decoder, the place where we dig into the details of corporate filings so you don't have to. Today we are looking at a report from Mangoceuticals, a company with a name that sounds like a tropical vacation, but the details might leave you with a bit of a financial sunburn. We will dive into stock grants, executive compensation, and what it all means for the company. This is a Form 8K filing, which is basically an alert that a company sends to the Securities and Exchange Commission, or SEC, about major events that could be important to investors. Think of it as a corporate bat signal. The date of the event reported is April 10, 2025. That's the day Mangoceuticals decided to hand out some company stock to its executives and directors. This filing is about compensating company officers. It explains that on that day, April 10, 2025, Mangoceuticals decided to give away a total of 325. Think of it like a pat on the back with company equity. As a bonus for their work in 2025, think of it like a pat on the back with company equity. This bonus came from something called the Second Amended and Restated Mangoceuticals, Inc. 2022 equity plan. Basically a pre-approved plan the company has in place for doling out stock. This plan has been registered with the SEC, so it is all above board. Let's talk about who got what. The report breaks down exactly how many shares went to each person. Jacob Cohen, the Chief Executive Officer or CEO and Chairman, received the biggest slice of the pie, a hefty 200,000 shares. Antonios Isaac, the President and a Director, got 60,000 shares. The other directors, Kenny Myers, Alex Hamilton and Lorraine D'Alessio, each received 25,000 shares. So the CEO got more than 3 times what each of the other directors received, which is something to note. So why should you care about all of this? Well, stock grants can be a good way to motivate executives. It means they now have a bigger stake in the company's success. If the company does well, their shares increase in value and everyone wins in theory. But it also means existing shareholders, people like you, own a slightly smaller piece of the company because there are now more shares floating around. This is known as dilution. The value of their shares is basically divided by more shares being available. Or shares being available. And so what can we gather from this? It's a pretty clear-cut case of a company rewarding its leadership with equity. It's important to keep an eye on these types of stock grants, especially when they are as large as the CEO's, because it is coming directly out of the shareholder's stake. Looking at Mangoceuticals more broadly, giving away stock can be a good thing for getting better performance from the execs, but they need to make sure it does not hurt the existing shareholders. Thanks for watching Corporate Decoder. If you found this breakdown helpful, please like and subscribe. And remember, always do your own research before making any investment decisions. Until next time.